Happy Friday afternoon from Eagle Financial. I'm Jack.
And I'm Bill.
And this is the Jack and Bill Show. Market recap. After a China trade delegation left the U.S. early today, the markets sold off. We had been up most of the day, but the S&P 500 wound up declining about 1.5% on the week. So about 1%. We're about 1.5% from the all-time high. Gold closed up at 1523, and West Texas Intermediate is the big story. Why don't you take off and tell us a little bit about that, Bill?
Well, a major event occurred last Saturday, and there was a major oil processing infrastructure facility in Saudi Arabia that was attacked by drones. It was an aerial drone attack, and it really kind of prompted us to delve into the issue of geopolitics of oil. And I know some of you may be thinking, who cares about the geopolitics of oil? Fossil fuels are so 1970s. Gas station lines, oil cartels, J.R. Ewing. Isn't this a new era? Wind, solar, electric cars, George Jetson. Not exactly. And speaking of electric, consider how we generate most of our electricity. It's through fossil fuels. So we had this attack last Saturday. We did see crude oil spike on the news, but stock and bond markets have largely shrugged it off. So, why should we care? Well, this plant, this processing facility that was attacked, is the single most important facility in the Saudi oil sector. It processes 1/2 of Saudi oil production. That's equal to 5 million barrels per day, or 1 out of every 20 barrels of oil used globally.
About 5%.
This is a global choke point for crude oil, so this is very important. Officially, we don't know who is at fault here. Allegations are being levied against Iran. And if Iran is deemed to be at fault and Saudi Arabia retaliates, worst case scenario is that this could escalate into a full-blown Middle Eastern war. Not good, not good at all. But here are some things that we do know. We do know that there has been a supply-demand imbalance concerning oil. We've had increased global supplies. Drill, baby, drill. So we've had all of this new supply come forth domestically through shale oil and gas production. And we have had decreased global demand for oil and gas. This is largely attributable to a slowing of the economy globally. But at the margin, we have had adoption of alternative energy sources. So we have a supply-demand imbalance. This year, Brent crude oil has been averaging about $65 per barrel. It has gone up, but it's not near the recent high or multi-year high that it hit a few years ago. But this is why this is important in this region. Countries like Iran, Saudi Arabia, and other Middle Eastern oil-producing countries are heavily dependent on oil. These are not diversified economies. They're anything but. And according to International Monetary Fund estimates, the fiscal break-even price of a barrel of oil for Iran is $126. Now remember, I just said that Brent crude oil has been averaging $65 a barrel. So if we agree that the break-even price is $126, then just do some simple math and you can see that this is really crippling Iran. Also, when you consider that Iran is an aspiring nuclear power, they are actively pursuing nuclear weapons, they are a state sponsor of global terrorism, and they are just overall a bad actor in that neighborhood.
Yeah, I'd like to throw in there, Bill, militarily speaking, the United States has really loved the fact or enjoyed that the largest oil and gas producer in the United States, in the world now, is the United States. And with all this shale oil and gas production, we've been able to keep oil prices down, which hurts both the Russian military industrial complex and their economy, and Iran. And conversely, we were hoping to get a trade deal done today, but high energy prices right now are hurting China, because China is the world's largest importer of oil, and there may be, if these prices spike any higher, there will be added pressure on the Chinese to work out a trade deal with Trump sooner rather than later. Sorry for the interruption. Keep going.
Well, and what Jack said about China being, the largest importer of oil and gas. Well, China signed a multi-year agreement with Iran to import Iranian oil. And at the same time, the United States has been imposing crippling economic sanctions on Iran. So Iran is in a very difficult situation. Iran needs desperately to export oil to support its economy. Now, conversely, you've got Saudi Arabia, who we consider an ally, maybe not our best friend in the region, but we have considered them an ally. Saudi Arabia is struggling in this low oil price regime. The estimated break-even price for Saudi Arabia is $85 per barrel. And Saudi Arabia has been going through its own turmoil in recent years. They are facing budget deficits. In the past, Saudi Arabia has been benefiting from large budget surpluses. 10 years ago, it was a surplus of 30% of their gross domestic product. This year, it is estimated that Saudi Arabia will run a deficit of 17% of GDP. Their monetary reserves have fallen from $750 billion to $500 billion just in 3 years. They're having to tap into global debt markets, something they haven't had to do in the past. And they are trying right now to privatize their oil company, Saudi Aramco. And that has been put on hold. So that, combined with political issues, the royal family in Saudi Arabia is facing threats both internally and externally from Yemen and indirectly from Iran. So this is a very volatile situation, a very volatile region. And so long as this oil production is curtailed, or this processing is curtailed until they can get this facility back online, it is estimated that Saudi Arabia is losing about $300 million per day in revenues.
Yeah, so they've been having to liquidate assets from their sovereign wealth fund, along with other Middle Eastern nations, which is largely invested in U.S. stocks and bonds to help with their deficit spending to cover the shortfall. And I think that's really good, the way you spoke about that, Bill. So we've agreed that we've had energy prices, oil prices, West Texas Intermediate, in the roughly in the $50 range most of the year, but we've always maintained that the world really doesn't work with even $50 or $60 oil. When you look at countries like Libya, their projected barrel price to balance their budget is about $114. Algeria, $85. We talked about Saudi Arabia and Iran. United Arab Emirates, same thing. So that ultimately spells trouble.
What about Venezuela? Forget about it.
Forget about it. Yeah, so that really caused some turmoil in the marketplace this week. The stock market kind of shrugged it off, but last week I had commented that the bond yields had gone up, and thankfully that reversed, and we had a strong bond market again this week. I think every single day this week the bond market showed strength, and that's somewhat of a flight to quality as well. The 10-year Treasury note yield ended at the week at 1.754%, slightly above the 2-year note yield, which means that the bond market is not, the yield curve is not inverted right now. So that's a recession watch type thing that we've been looking at. And the 30-year closed down again below 2.2% at 2.19. The Fed did indeed ease a quarter of a point on the Fed funds rate to a range of 1 3/4 to 2%. So, I might throw this out too. Bill, we've talked about this on prior episodes that, we've said that most bull markets, and with these low interest rates, the only game in town we maintain is the stock market. And since World War II, most bull markets don't end until 2 out of 3 things occur. And that is a tightening Fed, number one. We just said the Fed eased this week. And they have stopped their quantitative tightening. Number 2 is recession. I think we're very far from recession. We've averaged GDP growth of about 2.4% so far this year, although, as Bill indicated, the global economy has been slowing a little bit, and we think the U.S. economy has too. So that's why we had the Fed ease this week. And then the third thing is actually an energy shock. And we had a spike in energy prices. I wouldn't exactly call that a shock, but as Bill articulated, about 5% of the daily oil production, was taken out by these drone strikes, and it wouldn't take a whole lot to upset the apple cart. And initially the oil prices spiked 20%, with some people thinking that we could have come in here Monday and seen them double. So gas prices at the pump have gone up, a little bit, not a whole lot. I wouldn't really call this a shock, but this is something very important, to watch.
And the other thing is the opportunity set that is often overlooked here, and that is in the energy sector. The energy sector has not been a good investment opportunity in recent years. I mean, that's just a fact. But we are seeing some tremendous values in that sector, opportunities for buying things very cheaply, opportunities for very high income dividend yields. If you are an index investor and you're passively investing, these indices that you're investing in are underweight energy. And just given what's going on right now in the Middle East, if you are an energy producer, you're probably thinking a lot right now about the geopolitical risks of your assets. And all of this turmoil in the Middle East probably will usher in a phase of consolidation in the energy sector, and even more attention to U.S. energy supply, where producers can source supplies in safe environments. So there are opportunities right now in this space that are being overlooked.
Yes, and we might say both generally and specifically. I mean, if you look at the large integrated oil companies, ExxonMobil has a huge cash flow generator, a dividend yield of over 5%, Chevron at over 4%. One of the sectors that we like and we've been adding to that's done terrible in the last several years, which is why we like it right now, is the midstream MLP sector, where we've got dividend yields in the 6 or 7% with tax favored advantages. And these MLPs, which you can own in a diversified way, are instruments that move oil, gas, and liquid natural gas across the United States. So as the United States is moving towards energy independence, the MLP sector is a way to play that for these long-term take-or-pay contracts to move oil and gas to different sectors of the United States. And even from here in our neck of the woods in the oil patch, the Haynesville Shale, we have gas being moved down to the Lake Charles area to be liquefied and put on ships to go to Europe and Japan and places like that. So, what else did we want to add today, Bill? I'm winding down.
I'm already there. But we just thank you for watching. This is the first episode that we have truly been live. We hadn't done this in the past because we lacked the technological know-how. But we are now in a new phase, in our production here, and we do welcome any questions you may have. We would like to answer your questions, so please keep them coming.
Thank you.
Thank you.